right? So my yearly tax bill just hit and went up quick. It was an overall good year for the market, so I kind of anticipated that it would go up, but I've been questioning about if it's gone up too much in comparison to what the market has done around. So I wanted to put together some suggestions that you need to be thinking about as you're looking at this tax bill, from how to save money to things that you need to consider as you're going through it. Hi, thanks again for stopping by another Coffee with Coleman, where we love to discuss Washington, D.C., business, real estate, all that good stuff. My name is John Coleman, and I'm a real estate agent here in Washington, D.C. with the Jason Martin Group. Quick favor, if you like saving money, then go ahead and hit that like button. If you like learning about all things DC and real estate and all that good stuff, then go ahead and hit subscribe so you're alerted each time I release new helpful videos. And now here's a quick caveat is, on that tax bill, you likely don't have to pay that amount to anybody. In fact, if you have a mortgage, that's collected on a monthly basis, and your mortgage lender likely is going to pay that money for you. This is more of like an FYI, but if you're unsure, there's nothing wrong with reaching out to your lender to make sure that everything is okay and it's getting paid for you. So first, how are taxes generally set? Well, when you first buy a property, they're going to reset that taxable amount. They're going to look at the public record of what you just bought the house for, and likely it's going to be in the ballpark of what you purchased it for. The general equation used by owner-occupied homes is to take the sales price, divide it by 100, and then multiply it times 0.85. And then that's for the yearly rate. If you want the monthly rate, then just divide that by 12. So tip number one is to make sure that you have the homestead deduction if this is your primary residence. So this may be on that tax bill, it's also on public record, but what this does is it lowers the overall amount of the home from being assessed by about $80,000. So instead of paying that on that previous tax equation of like, let's say it's a $600,000 home, you'd actually only do that equation for $520,000 instead of $600,000. So that's the advantage of being an owner-occupied home in Washington, D.C. But also the real kicker of having that homestead deduction is that you are capped at 10% per year of what your assessed value can go up, which is a lot. However, some markets, some years go up even faster than that. So being capped is a good thing. It's also why the assessed value of some houses where people have been in them for a long, long time are actually far below what we would consider to be market value. It's not that uncommon that a first-time buyer will reach out to me and be like, why is the house listed for this? The assessed tax value is X. Well, this is why. They've been in it for a long time. They can't raise that value with how the market has been climbing over the last period of time. They also don't know if you've done any improvements to the home. So if your assessed value isn't quite where you want it to be, you can always try to fight it. They certainly don't make it easy, but you can always try. One way to do this is you can hire an appraisal and they'll come out to your house and they'll do an independent evaluation. But keep in mind that even multiple appraisers can end up at vastly different numbers. In fact, I saw the same property appraised for $75,000 difference, and the appraisal was performed within just a couple of weeks from one another. So it really can be a basis of opinion, and on a sales contract, they have a number that they're trying to justify. When they're just going out to a home and doing a basic appraisal, it's really just their interpretation of the market, and that can vary from one person to another. This will cost you somewhere between $500 to $700, and there's no promise that the assessor that did the tax stuff is actually even gonna care. Even if you get an official report, doesn't mean they're actually gonna change it. So you could be spending that money and getting that much for it. Another option is to get some of the comparable market stats. If you worked with me, go ahead and reach out. We can pull up what sold around you recently, or your agent, or you can probably find some of this online. And your idea is you're gonna pull this together and start to formulate an argument about why your house value isn't where they think it's gonna be. And if for some reason you actually think that your house is assessed lower than what the current market value is, be quiet. You don't want to trigger it so they end up raising it to that 10% if you have the homestead deduction. So again, they're gonna be resistant, but if you can make a case and don't mind trudging through the effort, it can be worth it. So give it a shot. Is that everything? So there you go. You know that you can fight it. You know that you need to get the homestead. You know that someone else is gonna pay for it. If you have any other questions around property taxes or anything like that in DC, feel free to let me know. And again, if your house is actually vacant or it's blighted, this is an entirely different conversation. Give me a shout because you're likely having quite a hit on your tax bill. So, well, thanks again for stopping by another Coffee with Coleman. Peace.